And I believe we are now live on YouTube. Welcome to our YouTube friends. We're glad you guys are here. We're coming into the second hour of group coaching here at TradeSmart University, just wrapping up the first hour. We found some interesting things. We were looking at ticker symbol SHOP. I'm not going to go back through the whole shebang here, but holy cow, I didn't realize how far this stock had sold off. It just wasn't on my radar at all. And it may be a stock that you want to check out. Go if you're a all access member or a foundation student, you can get the recording of the first hour and check that out. But just I challenge you, take a look at where your risk is with your stop versus some of these targets that are up here. It's just fallen so far and it's got some interesting potential to it. So we're kind of coming out of that conversation right now, and I'll do a very quick market overview. Again, watching this confluence line that we established here 3 weeks ago now, it was on this candlestick. It was on May 12th that I had this prophetic orange line. I don't believe in the moment Chris Burgess believed me, but now he's come around and he has admitted that it was a genius line. So anyway, we've been bouncing off from there. We had a little bit of a close call on May 20th. We came down, but we did not close below the orange line, and that would have been the signal that we were looking for, and we've been heading back up. So I want to remind you that the green box is in effect. That was established by measuring some of these ranges, and there's actually a larger one that we should measure when we get there. And what this means is, as long as we trade to or within, but not above the green box, we are technically still looking at a bearish market. Now, probably what will happen and what I'm anticipating happening if this support holds and if this was the bottom and we're heading back up, I would expect us to come on up, get above the green box, come back on down, test something in here that's yet to develop as a support, and then go on. And so I will be making my official, the market's bullish again decision right at this, not a gold star, but we can imagine it was a gold star, right at this magenta star. Prior to that, we just needed to trade very neutrally. And that's what we were talking about. I would keep an eye on your bullish trades for bullish opportunities. I'd keep an eye on your bearish trades for bearish opportunities. And I would manage my risk wildly, aggressively. You may even want to consider tightening your R a little bit. It's just a difficult season to trade. And maybe that's freeing for some of you guys. We were talking about in hour one of group coaching that, these kinds of markets here are no-brainers. I mean, you really can be pretty dumb and make money in this kind of a market. It just goes up. Everything goes up. Buy the stock, it goes up. And then you get into these markets here and it washes out the people that only learned and cut their teeth on bullish markets. And I don't mean to be disparaging. I probably would have reworded that if I had a second chance at it. But I was one of those people because I really learned to trade. I was the inverse of those people. I'll go all the way back. Well, we may as well. We're almost there. So I really made a lot of my original money during that crash, the 2007, 2008 crash. I mean, I made stupid cash back then. But I didn't catch the memo that there was a V bottom here. It's going up. So like this whole way, all the way on up, I kept thinking it was one of these little pullbacks in the larger downturn. And it really wasn't until we got to right about here, about mid 2010, that I kind of found my sea legs again. I was like, oh, I see how this works. And then flip my perspective. So 2009 was a very difficult year for me to trade. And I think that's what people are experiencing right now, just the inverse. A lot of you all cut your teeth. You got interested in the market at the COVID bottom while you're stuck at home. So you started trading the stock market. And this was super easy. Right? You just bought long, bought calls, put cash in your jeans, and now we're sitting here. And this is an inflection point. It's very difficult to tell whether, we're going to just keep shooting on up, or are we looking at another peak like that? I don't know. And candidly, nobody knows. So you've just got to manage your risk, trade hedged. That's lingo here, I suppose. We've got a course that Chris taught on doing that. And that just simply means trade both directions. Find bullish stocks that are going up, trade them. Find bearish stocks that are going down, trade them, and manage your risk appropriately. So anyway, that is actually a great segue into what we want to talk about in this particular session. We're going to be discussing, I'll call it risk management, but really what it is monetization. We have a formula, 3-step formula here at TSU that we teach emphatically for how to put cash in your jeans trading the stock market. Step number 1 is being able to pick the direction a stock is going to go. You saw us do it right here. Those of you that have been watching, go back, watch this video. I'll tell you the date, the group coaching on May 12th. I drew that orange line prophetically. It's on YouTube. You can go look up the video. We drew that line in there and it's come to fruition. That skill is analysis, being able to forecast what direction you think a stock is going to go and let that inform step number 2, which is strategy, being able to use the right money-making strategy at the right time. And then the third step is relentless risk management. If you manage the risk, the profit will take care of itself. Or another way you can remember this, kind of a catchy little way, is analyze, strategize, monetize. That's your job as a trader. Analyze, strategize, and monetize. And I call the risk management monetization because that is where the riches are found. I promise you guys, especially when we're in a confusing market like this. And so that's where we're headed. We're talking about monetization of your trading, or the risk management of your trading. And, you know, I didn't tell the guys this ahead of time, but maybe I'll set a soft target, soft goal for myself to let Chris and Scott do most of the talking, because these guys are wicked smart in the world of risk management. And I think they've got a lot of good things to share. So let's change it up and actually, well, which one of you guys wants to go first and kind of lead us off? I have an idea of what y'all are going to talk about, but I don't know exactly.
Chris, you want to start?
Yeah, I'd be happy to. So what Josh was talking about before with the, leave the charts up.
Oh, rookie mistake.
What Josh was talking about before with the trading hedged or trading balance, it's nothing too complicated or too crazy. It's just pairs trading, right? So every time you buy something long, sell something short, and vice versa. So that way, you know, you're not having an unbalanced portfolio where all you have is a bunch of longs. And, you know, if you're in a market like the second half of 2020 or all of 2021, right, where everything just goes up all the time, then sure, you can get away with having a long only portfolio. You know, your 401k is going to be doing great there. But when we get to markets like 2022, when that's not the case, that's when you really got to make sure that you have balance in your portfolio. So you're not, you know, just completely biased one way or the other. Because, you know, even if you were just completely bearish from the beginning of 2022, overall, you might be making money, but there's still been periods where we have strong surges upwards, right, against the dominant downtrend for this year. So it always helps to make sure that you have positions that will make money no matter what the market does. So that was one of the things that I've been focusing on a lot lately, is getting my portfolio more to neutral, delta neutral. So if you're familiar with trading options, delta basically measures how directional your option trade is. So the higher the delta, the more bullish it is. And then a zero delta would be perfectly neutral. Negative delta would be bearish. And so the goal for my portfolio is to get my overall portfolio fairly delta neutral, which basically just means as the market goes up or down, I'm not too heavily bullish or bearish. So like for this week, for example, since I'm much more delta neutral at the moment, my hedges, right, to the downside, my bearish positions, they're not making much money, but my bullish positions are doing great the last couple of days, right? So you have kind of a balance of both of those things. And when you do this with options, well, you can't lose more than you paid for the options, right? So my, just to take the last couple of days as an example, you know, let's say I have 5 calls that I bought and 5 puts that I bought, and that's my portfolio. Well, my puts might all be losing money over the last couple of days here as the whole market's going up, but I can only lose what I paid for those puts, right? Whereas my call options, those have unlimited profit potential while the market is still going up, right? So I can end up making way more on the directional play, even though my overall portfolio is delta neutral, right? And that's essentially the strategy of being hedged that Josh was talking about. I am curious too what like how Scott handles risk management and all that sort of thing. So I'd be interested to see your take, because I think we normally talk about like directional analysis and that sort of thing. So it'd be fun to talk about the risk management side for a change as well.
Agreed.
You want to share your screen, Scott?
Yeah, I'm going to show mine because I want to. Everybody should see it now. All right, so I want to talk about a little different aspect of this for a minute. I think I've shared this in the past few weeks, but I'm just hearing more and more stories of investors, retail traders. I'm talking whether investors who are older than me who have gotten hit really hard in the past 5-6 months. The market, the NASDAQ flew down almost like 40% in certain areas, right? And so one of the things I've taught to the Traction Group for the past year is that you need to have a defined spot on your chart where you're going to enter. This isn't some big secret, right? You have a defined stop and you to obey those rules. Okay. You are a risk manager first. All seasoned traders know this. So let's just make an assumption that you're going to buy through the breakout of this range. Okay. This is actually Valero's is one I've actually pointed out in Traction Group recently that has done pretty well here. If I know that this cluster, this zone, and I know there's a lot of people who trade, you're so focused on bar risk, you don't see the zone of risk. When you deal with floor traders, professional traders in my lifetime, they're looking at this like, man, you're within an ATR. That's ample. So you can define a simple amount of risk without trying to get really cutesy with a specific bar. Everybody's different flavor. So if this was my entry through the high of this, what's my risk? Somewhere just below that zone. The beautiful thing about geometrics or about any kind of risk management is use as proportional risk. So all I did was take that zone. I'm using the bodies. I always say, look where the bodies are buried. Look at the bodies of the candle. Okay, so take the shadow of the tail, the wick off the candle, depends on what you guys call it. Everybody's different in the industry. You'll notice I got a proportional move. Well, there's a target. When I get there, take some profit off. Don't debate it. Don't eat dinner and then decide, take some profit off, move to a no loss stop at that point, or somewhere to reduce your risk of it going against you in case it does, because we never know. The Fed could say something, as we were saying in the past hour, that jerks the market around and slams it down. You get stopped out. You just never know. But as Josh will tell you guys, you know, he likes that win-loss ratio. We want to take money as we go higher.
So good. My win-loss ratio.
I know how much you love it. So I've pointed this out again and again. This is a concept I have taught for close to 2 decades now, which is, and this isn't some big secret, but yet you see a lot of retail that won't do this. They won't have initial stop. I've seen a survey recently of retail traders who were struggling. And I think the number, I don't remember right now, it's like 40%. What the number was, it was like just an exorbitant amount of people who don't use a stop at all. And yet of the, let's just say it's 100 students, of the 100, the ones that weren't using stop loss, money management, risk management were not consistent. They were much more consistent at losing money than making money. So I don't mind if you're a break-even scratch trader 80% of the time, if that 20% can make you what you want to make. I know that seems like an odd comparison, but to get into this, it doesn't matter if you're a day trader or you're an investor, the same logic applies. I know someone right now, unfortunately, who is down, not one of my students or not from TSU, it's completely outside, just an investor, whose their portfolio is down 47% year to date. It just makes you just want to cry. And they're older in life, and it's just like, because they believe you buy and hold, guys. And where I'm going with this is, the only difference between a trade and investment is the duration of time. Just time, not targets, not risk management. It doesn't change. And so I feel blessed because I share all these things with you guys, but I see it with my son at his college and their fund. They don't carry stop losses. I'm not kidding y'all. They don't do stop losses. They do profit. They do I call it like a profit removal, like a profit stop. If the portfolio gets out of balance, going kind of what Chris is talking about, if their portfolio, let's just say on Valero, and Valero has grown so much in the portfolio value that the percent way the portfolio puts it at jeopardy, they have to scale some off. So let's just say it was 5% of the portfolio when they bought it. Now it's worth 15% of the portfolio's value. Well, they have to sell it and pare it back down. I'm like, well, where's your stop loss? There is no stop loss, Dad. We just keep buying on the way down. And I'm just like cringing at the moment. So you
Dollar
take,
cost averaging is the biggest lie.
it's insane. So when we talk about these different areas, guys, we're trying to cover a lot and know, and, roughly an hour here, whatever we've got. But the most important thing is you're a risk manager first, just like an actuary for a life insurance. When Josh takes out $5 billion in life insurance for the family, right? They want to know how healthy is he. So he does a blood test, whatever, his age, they throw all that stuff in there and they come out with some sort of calculation of what it's going to cost to insure him. That's how you should look at the markets. Is it a high probability? Where's your stop? Where, if you go wrong, how much can you lose? Okay. Josh has addressed this before about if you will be disciplined with this, if you're using a 1% stop, well, if you're at 100 grand and you lose, let's just say you lose 10 grand. Now you're 91% of 90 versus 1% of 100,000. As you go lower in the account value, that 1% becomes what of that value. There's lots of ways we could do this, guys. I mean, we could spend a whole 8 hours on this concept and still not do it all justice, probably. But today, if I could just drive home the point, and I'm going to give you guys a positive coming out of this, if I can get you to define your entry and always define a stop and never disobey your stop. Every Dear John story I've ever heard is, if I had just used the stop, Scott. And I'm like, why didn't you? And then their losers get out of control. This brings me to the next point of this. The other thing I teach is you've always got to have targets. Always, always, always. I see Josh do it all the time. Okay. So you've got to have targets. You should set 3 targets. I didn't say you're going to get 3 targets. You should set 3 targets, entry, stop, and 3 targets. And then you can have a trailer that goes behind it. So I've got a student in Tractions, been with us for the past year, programming an app to trade what I'm teaching in there, and been with me for a year, and something clicked. The other piece of this is, guys, when you look, I'm going to type on the screen and I'll hand back off to you guys for a minute. So let's pretend that I'm going to have 1,000 shares right here of this stock. It doesn't matter why. Okay. I'm not trying to be appropriate about the dollar amount. Let's assume you have 1,000 shares to get through this example. How many of you are going to, let's just add one more target here. Sorry, guys, just bear with me. So pretend that line's my 3rd target. The one in between there where the boxes are, that's my 2nd target. And let's just use this. This is not proportional, but just indulge me here. And let's take off the boxes now, just because I'll get this analogy down home to y'all. Do it like that. Okay, so 1st, 2nd, 3rd targets. How many of you are going to take 100 shares at the 1st target off? Indulge me here, because there's a big lesson to teach you. You're going to take 300 shares here off. And what's that going to leave right up here? How many still be left with? It's going to leave what? 600 shares. How many of you are going to do that right there? Now, here's what's interesting about this. What is statistical probabilities you're going to get to the 3rd target? Just think about this on a distribution. If you drew a bell curve on here, what is statistical probabilities you'll get to your 1st target? But you're hoping for the swing for the fence, grand slam at the 600 of the 3rd target, because that's what you want. I understand why you want it. Well, if you will preload the bases, I don't care if it's 400, 300, whatever. I don't care what the distribution is, but you should have the inverse pyramid kind of feel. I mean, the pyramid kind of feel here, forgive me, where you're going to have the bulk of it at target 1, then ladder up to 2, and then 3, and it should decrease. Or on 2 and 3 targets, split it equally. Because statistically, I know there's some clients I've turned around the past 20 years. The 3rd target is a lower probability of being hit. Now, we could debate that, or how do we hit it more frequently? But most people are going to go all in, all out. I don't preach that. I don't teach that. Why? Because the psychology of your brain and how it hurts you. So if you're willing to have an entry and always use your stop and obey your stop, and you have an edge, you should hit your 1st target pretty good probabilities. Okay. Then your 2nd a little less, and then your 3rd less than that. Without going through the distribution in this hour, I front load heavier to come out at target 1. 600, 200, 200. It could be 500, 300, 200, but I'm going to take more of it out right there. And I tell you this because I have a student in Traction who's programming an app to trade what I'm teaching. This was the one thing that didn't click. True story, because they've sent me the screenshots of it. I've gone and watched it going from, say, 7 out of 10 trades. I don't know what the exact number was. Let's just say 7 10. I'm seeing some green and some red. I might be seeing a mix of 50-50. Now I'm getting screenshots from her, and it's literally every trade I'm seeing green line up. I am not going to promote and tell anybody in the world you're going to get those results. I'm not. I'm trying to tell you, people I work with professionally, some high-end traders, there is this mentality that tends to flavor through. You should consider it. You could take the same logic. It could be 300 shares, guys, and you're going to take out 150 the first one and then whittle it down. But it's very powerful, and I've seen it work for a lot of people the years I've turned around, because we know statistically, probabilities, you're more of a tail of the bell curve to get your third target, unless the targets are so tight. If that's the case, what's the point? And we could do more with this, but I just want to leave this thought process with you guys. You got to have an entry. You got to have a stop. You can never disobey your stop. That's what keeps you in the game. I don't care if you scratch out break even, because if you have an edge and you let your winners run, it's a big deal. And I know we're not really talking about hedging right now with this conversation, but I watch more retail traders who are really good technicians, really good chartists, who do not make it. It's not because your charts are bad. It's because you lack the money management, discipline, and risk management. And we were talking about today's class. We talk about this is just on my mind because I'm watching people blow up, not ones I work with. I'm watching them blow up 2 years worth of returns in 6 months, because they don't have risk management. They're not trading the targets. They're not extracting the targets out when they can. And they just keep hoping to hit for the fences. And so this is a passion plea. If you are in that camp, to please stop, because I've proved this over 20 years of doing this with people, and I'm not taking their trades. And the funny thing is, I get their data back and they're like, man, I don't hit the third target that often. I'd rather take that 100 shares, take that and roll it back in and compound. So it's different for different people. I would suggest you play with it and look back at your own results and kind of do some testing in the past to see how this would have played out for you. People always come at me and say, oh, well, you should, it's not ideal, especially quants. I'm like, you're a quant, you're not a retail trader, and you don't have emotional issues like they're going to, respectfully, because the computer's trading for you. We actually have to push buttons. And so this will set you free in so many ways if you get some sort of logic. You could have 5 targets. I'm not sticking to 3. But once you do this and you build confidence in yourself, guys, you will grow in a way you've never seen as traders, because then you have the confidence to say, well, you know what? This is a high probability. I'm going to take half off and I'm going to just let the winner run. I'm going to use my trailing stop to help me take me out the rest of it. So I know that's really long-winded, but this is a critical piece of what I use to turn traders around their careers, and it does work quite well. Play with it, test to see if it helps all of you. So I'll defer back to the other guys and let you guys chime in now if y'all, whatever y'all want to think, say, and go from there.
I think that's great, Scott. I want to grab Faye's question on YouTube. Faye's a long-time faithful student at TradeSmart, and she said her Vanguard pension is down. I assume I can read this because you posted it publicly. Is it better to have a pension trading account? So I think there's a few ways I can interpret that. I think what you asked is it okay to trade my pension account? You could have also been asking, is it better to have a pension or a trading account? So I'll answer it. This exact question was asked of me yesterday by a rather successful friend of mine, and they were trying to figure out like what's happening in the stock market, is it crashing or whatever. And they had just met with their financial advisor, and they were trying to strategize how they were going to deal with this. And so I said, well, first of all, this person was in real estate, they're a real estate investor. And I said, investing in the stock market versus trading the stock market is like buying a house that you're going to live in for 10 years versus buying houses that you're going to flip in 10 weeks and you renovate them. Neither strategy is wrong. Living in a house and watching that asset go up in value is great. A lot of you guys have done well with your real estate this year. flipping houses is not wrong. It's great. You're adding value to the marketplace. But if you try to apply a house flipping strategy to the house you're going to live in and enjoy, or if you try to apply the house you're living in strategy with a house flipping outcome in mind, you're going to be wildly disappointed. And so, if you're thinking about an investment as a place to go and park cash, I generally advise that you listen to your financial advisors, because the strategy is completely different. And there could be tax reasons why you don't want to get into and out of trades quickly. If you hold on to a trade for a year or longer, you're going to be taxed at long-term cap gains, which is 15%. Versus if you're in and out of a trade, in a week, you're going to get taxed at your earned income rate, which for most people is going to be significantly higher than your long-term cap gains. So that's a consideration. So what I advise, that's a terrible word. I don't give trading advice. We all know that, right? I should have replayed the disclaimer here before the YouTube show. This is not intended to be a specific investment or trading advice. But what I simply shared with this person was, I said, look, if you are really fearful about the market going down and what that's going to do to your retirement account, just go ahead and put some cash in the market and buy yourself some puts on SPY. Just buy them outright, and then you can stick that in your retirement account and offset whatever the losses are if we've got major drawdown. Then you're not impacting any tax strategies. You're not impacting any long-term investment strategies that your financial advisor is working through. I mean, they're not bad people. They're good people. They're just playing a different game than we are as stock traders. And it's okay. It really is. So that's kind of my thought there. I am emphatically against people trading their entire life savings retirement accounts. The probability that you're going to screw up is just too high for you to be risking that kind of cash. You need to trade discretionary income. For some of you, that's 20,000. For some of you, that's 200,000. For some of you, that's 2 million. But if you're trading a $2 million account, you better have a good solid 75 million that's behind it somewhere in an investment. So in those, I just pulled those numbers out of a hat. Actually, that number came from, I had a friend of mine who sold his business for just over 60 million, and he was trading $1 million account, but he can afford to do that. If he loses $1 million, he's got 64 other $1 million to play with. Tough life, right? So Faye, I don't know if that, in all of that, did that answer your question? I have more thoughts on risk management, but I want to hold true to my personal outcome and toss the ball back to Burgess if he's got something to continue on with here. Otherwise, I can keep riffing.
Well, something Scott just briefly touched on is, I think, probably one of the biggest keys to this. As traders, I can't really talk much about the investing side of things, but as traders, one of the things that Scott mentioned, the quant funds that he was talking about versus dealing with retail traders, is retail traders actually have to press the buttons, right? We don't have a machine doing this for us. And so the problem that we run into is that we're humans. So our emotions get in the way. And one of my old mentors, when I was learning this, always used to say, humans make bad traders, right? We need to essentially be robots, but our emotions get in the way. When we start losing money, well, we've put all of this time and analysis into our charts, and we think, there's no way that we can be wrong. I studied this chart for like 3 hours, right? Like, look at all the lines I drew on this chart. There's no way it can be wrong. There's no way I could be wrong because I put all this work in. So the market must be wrong. I have to wait for the stock to come back. I know it just hit my stop, but maybe I just placed my stop at the wrong point, right? I should lower it. Actually, it should have been down here, right? And so we'll move our stops or we'll ignore our stops because we want the market to come back. There's no way we could be wrong after we did all that analysis and so on and so forth. So our emotions get in the way. And when Scott was talking about the biggest problem is, 40% of retail traders don't even use stops, or the ones that do often move their stops or they ignore their stops. That makes me cringe very, very, very much. And so
I actually would have thought that number was lower. I mean, I'm actually shocked that 40% do use stops. I'd just like to think TradeSmart University just had a little impact in this world, maybe.
I certainly hope so. At least on our students. If you're a student of ours and you don't use stops, you're doing it wrong. You need to come back to foundations of stocks and options. But yeah, that's just kind of the point I wanted to make. If we look at so few traders use stops, well, why is that? It's because of the emotions, right? So ultimately, you have to have a way to take the emotions out of the trade. You have to have a plan ahead of time before you get into the trade and stick to that plan no matter what. You can't evaluate the trade while you're in it, right? You have to have the plan already set up to go before you put money on the line and before the emotions take over. And then you just execute the plan to the script. And if you don't do that, how can you ever know if your strategy is any good, right? If you change it and you just trade by the seat of your pants every trade, well, then how do you know if your strategy is good or if you're just getting lucky because you do it different every time? The only way you can evaluate whether a strategy works or it's profitable or it just meshes with your personality or your trading type or whatever is to execute it exactly the same every way. And if you don't have the win ratio that you want or whatever, then fine. At that point, you can move on to a different strategy. Or try something else that might fit your trading style more. But how would you know that if you don't execute the trades exactly the same every time? So that's really the point that we need to get to as retail traders.
How many of you would watch a football game if they kept moving the goalpost? I mean, seriously. I mean, this is what I see retail traders do. And his comment that he doesn't need it because the way, but thank you, Chris. Because people on YouTube, Andy said, all my trades don't need stops since they are a spread. My max loss is predefined. And that's one. Thank you, Chris, for saying that is a stop. The point of that is to stop you from blowing up. And I'm not talking about Andy here in this particular case, but the way his strategy is set up, it is the equivalent of a stop. That is to keep you from blowing up. I'll make one point to this. Back in 2003, 4, I was working with about 80 traders. Had a guy, I remember his name, I won't put it in public domain. He's out of Anchorage. He had been hurt on an oil rig back in the day. He was under collecting some disability, whatever it was. He was trying to trade. And he said to me, you made a really good point. I said, what? He said, I finally understand. He said, as Chris just said, we go through the hours of setting up our chart. We do what I call you frame it before you trade it. I talk about this all the time in traction. If you don't frame it, you can't trade it. You still frame it. Everything should work. And then it doesn't. You don't know why it doesn't. This time it just doesn't. Statistically, the probability doesn't work out. He said, the stop is for exactly that, when things don't work out. So I don't hope it comes back. And it was like the most prominent thing he took away from me. And it really resonated with him because he didn't understand the point of a stop loss. I've actually seen data that supports I'm not advocating for this, but I've seen data that says you should never use a stop. I just cringe, but there's data that says you never use a stop. And I have a hard time with that. Okay, if you're an investor, okay, I guess you can justify it. I don't know. I can't. With what I've seen, the people I've seen blow up. So that's why I come back to it is to control your risk. The one thing I love about options, your worst case loss. If I buy a call and I paid $500 for one call, what is the absolute worst I can do? How much money can I actually lose? $500. I don't do risk management with options. Let me say it like this. If I'm doing a straight up call, like I think the stock's going to go higher. I think Valero is going to go higher. Okay. In this case, let's just pretend that's the case. And I spend $500 and I buy an option. The worst I can lose is $500. My stop is not based off my option. My stop is still based off my chart. And I watch a lot of retail try to use a stop loss on the option. I'm like, the value of the option contract, because the stock could move against you and then rebound really hard. My stop is always based off of the chart. And that also gets into the Greeks. How are you pricing your options? All that goes into that, they do in foundations of options, all that with TSU. I just point this out because I've watched retail traders try to make their stop loss actually the value of within the contract. I don't do that, Chris. You may, but for me, I use my chart. I'm using options as leverage or as a proxy versus trading the direct shares. And different people, different strokes. I'm just telling you how I go about it. So, Chris, you want to comment about that? Please do, or anybody else. But I don't know your thoughts with that. But
Yeah. So what you want to do with that when you're trading options and you want to, exit your option trade based on what the chart is doing, is you want to use what's called a contingency order, right? So you put an order in. It's a little bit fancier depending on how your broker's set up. It might take a couple more hoops to jump through to set up a contingency order as opposed to just a regular stop order. But essentially what you do is you set up an order that says, if the stock gets to X price, then exit my option, right? So it's an if then order, unlike a stop loss, which is just if the option price gets to a certain price, exit it. With a contingency order, the exit order for for the option is contingent on what the stock is doing. So you say, if Apple gets down to whatever, $100 per share, then exit my option position, as opposed to exit my option position if it loses 50%, right, or something like that. So that's what you want to do for that type of order.
Yeah, I'm a fan of option orders for those of you that have trouble either committing to a stop or placing the stop. You don't know where to place the stop. The key is you can't over position size. And I've seen otherwise intelligent people do stupid things with options where, they take on too large of a leveraged position, and then you just wipe out your account even faster. So, in fact, this is probably a good segue. I wasn't sure if I wanted to go here, but I think I do, because not everybody that's on YouTube is in Foundations. And if you are in Foundations, this will be a good review. Can you guys see this? I'm still sharing my screen, right?
Yes.
Yeah. So there's a methodology to position sizing. I'd like to think that I invented this. I did not. I was introduced to it by Alfonso, one of our instructors. I believe he was introduced to it by who's the Trading in the Zone guy? What's his name?
Mark Douglas.
Mark Douglas. Do you know, Scott, is that the origination of this system?
I don't know that. I don't know.
Anyway, try to give honor where honor's due. There's nothing new under the sun. It's just how we combine things together into systems and strategies. So this is the official TSU way of managing risk for the most part. There's some advanced strategies that fall outside the scope, but this is how you trade the R's. First of all, R is an abbreviation that we use for a unit of both risk and reward. It worked out nicely that both words start with R, so we call it the R system. It's established by defining the difference between your entry and your stop. And as a pro note here, the stop should always be established first, then notate the size of your R. We have extensive training on stop placement, but a really great rule of thumb is if you're looking at a chart thinking, I should have thought about a bearish position instead of a bullish position. You have that change of mind from up to it might be down. That's probably about where your stop should go. So you do that in advance of anything else that you do. So here's an example of Starbucks here. Starbucks is obviously trending on bullish. There we would be looking at a potential entry. Words are coming hard to me. Potential entry at about $88. And we could put a stop down here around $84. Why would we do that? Well, if price action came down and dropped below this channel, we would probably think to ourselves, I should have got into a bearish trade on this, or I'm certainly not bullish anymore. We could be settling into a sideways move or all kinds of means and nasty things that happen after you get outside the bottom of a bullish channel. So that's why we put our stop down here. Now, this is in the context of a larger presentation, so you wouldn't necessarily be aware of my favorite tool, but I'll just tell you what my favorite tool is. It's the box. Or Scott has refined this. I've learned so much from Scott. He says this is geometric analysis. Doesn't that sound way more sophisticated than the box tool? So we're going to use some geometric analysis here. And I'm drawing a geometric shape, a box between my entry at 88 and my stop at $84. So in this example, the box is worth $4, or the R is $4. Then we go ahead and say, well, what would our potential target be? Now we're just stacking boxes, literally stacking boxes. I do this all the time. And the vernacular that we would use if Starbucks were to achieve our target here is, hey, in this particular case, I had a 2.5 R gain on this. 2.5R. That's how we would communicate this to each other. That's how we talk about it in the Discord channel and all those things. And so once, just immediately, you take all of this sting of, how much money you made, how much money you lost, whatever. It's like, dude, we're just trading R's. In fact, I'm going to tell you something that'll blow your mind here in just a second, but let's talk about how we establish what the R should represent in terms of our account size. The primary method for establishing your ideal risk or your R in a trade is your account size. So a 1% R, R proportionally to your account being 1% is conservative, 2% is okay, 3% is more aggressive. I would encourage you to live in this 2% as long as your win-loss thresholds are acceptable to you. And then we've got a whole series of rules why you might want to decrease your R to 1% or potentially increase your R to 3%. Now, here's what's going to blow your mind. If you make 1 R a day, your job is to show up and just make an R. You will 12x your trading account in 1 year. Now, if I were to say, come to TradeSmart University and we will teach you how to make 1% a day, nobody would sign up for that course because you're like, 1% is stupid. But it's not stupid. 1% a day, you'll 12x your account in a year. Now, I'm not advocating that you even remotely make that a goal. You're not going to do it. I can almost guarantee you're not going to make 1 R a day. But here's the good news. If you make 2 R a week and you set that at 2% for your R, the regular R, you will more than 3x your account in a year. Did I say twice a week? If it's twice a week, you almost 8x your account. 1 R, 2% R each week is almost tripling your account. The numbers are extraordinary. Now, one of the major rules that you should consider is your win-loss ratio. If your win-loss ratio starts dipping much below 70%, so 7 trades out of 10 are winners, 3 are losers, I would lower your R. If it's at 3%, lower it to 2. If it's at 2%, lower it to 1. I also have a personal rule that if I lose 3 trades in a row, I automatically have to cut my R in half, no matter what it is. If it's at 1, I go to 0.5. Right? That will save your butt. When the market gets wonky, kind of like it is now, or you get wonky, that will save your butt. So let's do a little example of this. Yeah, Sorties in our Zoom, our regular group coaching said, I'll do 1% a week. So let's assume this is a $4,000 account. Our stop is $4 on Starbucks. The current maximum allowable risk is 1% of our account. So that's $4. Your win-loss ratio in this example is currently acceptable. How many shares can you buy? This is position sizing. How many shares can you buy? Well, if you can only afford to lose $40, and your stop is at $4, how many is it? Go ahead and type it in the chat pane. I can't see YouTube right now. I'm sure somebody's typed it in. The way I'm broadcasting, I can't see everybody. The answer is 10. If 10 shares lose $4, that's a $40 loss, which is your maximum allowable drawdown on your account. There it is. 10 shares at 4R equals a $40 risk. Y'all, this is going to change your life if you've not adopted this kind of a stringent risk management system. The structure helps remove all of the emotions associated with risk. The system is extremely forgiving. It's literally impossible to go broke. Now, literally and actually are 2 different things. But if you keep cutting your R and reducing your R and resizing your R as you're going down, hopefully nobody is, you lose money slower as you're losing money. So it's literally impossible to go broke. It expands and contracts based on your performance, and it's an excellent foundation for future advanced trading strategies. So that's the crash course into R. We go into more depth in our Foundations of Trading series. I encourage every one of you. Level 1 is free right now. I can't promise it's always going to be free depending on when you're watching this recording. But right now, Foundations of Trading is free. get signed up for that. Levels 2 and 3, there's a small charge to go on, but we cover what I just did in the free level 1 class. So position size your trades, friends. And what that means with options, so let's say you had that $40 maximum drawdown. That means either A, you've got to be really great at placing stops with options, or simpler, you can just buy a $40 option. That's it. You limit yourself to stocks that have options at $40. Then you can never bust through your maximum allowable risk threshold.
I could just jump up and down at how important what Josh has covered. Anybody I've ever seen turn around has struggled, has adopted what you've just seen in some capacity of that, if, well, pretty much identical to it. I mean, depending, everybody's different. I cannot stress how important what he's showing you is. Like, this is, I could go on a massive just rant about this right now. I won't. I will just tell you all. And I saw where Andy's asking the question, you see somebody doing 12X. I got a hedge fund right now that's destroying that number and a whole lot more with it. I mean, I can't show track records for legal reasons with all this stuff, but it's if you don't get it, this is so critical. Like, and I appreciate Josh doing this, because that right there can turn your careers from upside down to around. If you'll just learn to adapt it, you can do it in a spreadsheet, the whole 9 yards. Sorry, Josh, go ahead.
No, I just saw in his comment, and I want to make sure we are crystal clear on this. I'm doing something here on the side. Times oh, this is 1% a day. I forget how many trading days are on it, but this math will work as well. Somebody can look up exactly how many trading days there were. I did for that slide. I think I actually said in the context there, I don't think you will do this. I don't think that as retail traders just trying to come in and do their 1 trade a day and do 1%, I don't think you're going to 12x your account a year. My point is, what if we just said our job is to do 1 hour a week, right? Or in this case, we did this mathematical example here, we did 2 hour a week. What is the result of that? I'm just doing some math here. And the answer to that is, so a 2% R, this is how you read this. You know, if it's $1,000 account, one is 100% and it grows by 2%. Okay. So it goes up by 2%, 104 times. So 52 weeks in the year times 2 is 104. $1,000 will turn into $7,841 if you did that. Here's my personal goals and what we keep on track with a benchmark. This is a good way of saying this too. Like, what's my benchmark? Like, how do I know if I'm doing a good job or a bad job? Because you may think that doubling your account is a good job, but maybe you should have 4x your account. I don't know. What's my benchmark? So for the TS2 public trading account, a 2% R, not a 2% F. 2% R once a week is almost nearly tripling the account in a year. So 1,000 turns into 2,800. So you got a 180% return. Did I do that math right in my head? That always confuses me. It's like 100%, it doubles 100, whatever. That's my job. And, you know, I hesitate to say this because it doesn't make for great marketing. You know, again, if I were to go say, hey, would you like a job trading the stock market? People are like, no, I want to leave my job. That's why I want to trade the stock market. But, you know, what's the old adage? You sell them what they want and then, you know, teach them what they need.
Yep.
And what you need to understand is you've got to treat this like a job. And so you show up on Monday morning and you're like, self, I just need 1 R. That Starbucks trade, that $1, 1 R is what we're going for this week. Net positive. So if you start off with a big L on Monday, guess how many R's you need? 3, because 1 R gets you back to neutral roughly. And then the next R gets you to profitable. So you've 3 trades, I guess I should say. You don't need 3 more R. Okay. You need 2 R to overcome the 1 loss. That's my job. Sometimes it gets done on Monday. Sometimes it gets done on Tuesday. I will tell you I'm the best version of my trading self if I just do that and walk away. I don't know why it is, but if I feel like I'm on a hot streak and I'm going to just get like 5R this week, it doesn't seem to work out as well for me. I don't know why that is. It's probably a me problem, not a you problem. But I do really well just saying, got my R, I'm good. Alfonso says that take money when the market makes it available to you. Here's my R, peace out. 100% win-loss ratio. Mm-hmm. So that's what I mean, Andy. I just want to be crystal clear, and I am not suggesting that we have 12x our account. I'm not suggesting I saw a dude turn 30,000 into $1 million once. So what would that be? I mean, that's more than 12xing. It was ridiculous xing. It took him, I think, about 2 years to get there. But as far as our students, his name was Paul. That's the greatest gain that I'd ever experienced. That's one guy out of probably 500,000 people we've traded or we've trained. Sorry, Scott, I didn't mean to interrupt you, but I was
I'm glad you did that because I want people to understand it. I would, I would love to discuss, dig in this so much deeper than we're doing today. If you're trying to take some away, whether YouTube or, with us in other forms, whatever you're coming from, you're watching this in 10 years, that what Josh is telling y'all, I've known for 40 years of doing this, 27, 28 years of my career. I've tried it the other way. It didn't go so well, by the way, for what it's worth. And anybody I turn around, every single trader I've turned around, what Josh has just showed you is like oxygen to the lungs. So people can dismiss it, but then you find out the really successful traders in the long run, and I'll just use equity traders, I guess, in this particular case, this is absolutely critical mass to their success. And I know I sound like a broken record, but most traders just think if they had a better strategy, a better whatever it is, it'll solve their problem. And I've seen people who are phenomenal technicians blow up because they did not do what Josh just covered. Like, this should be like a pinned YouTube video, at least that section of it. That's how much value I place on it. Cannot stress this hard enough to everybody. That is the difference between long-term success in the industry and probably a short-term career. I'd be willing to bet if we could take 100 students, 40 who never use stop, and just do this, you'd be amazed at where those 40 would be and their potential opportunity for success. Again, there's more to it than that, and I get that. But as Josh said, the risk of going broke. Gann's whole thing was take a $100,000 portfolio example, divide it in 10 portions, never risk more than 1%, right? That was his whole thing. The risk of going broke is so small. And if you're still not making money, like you just continue to chew through it, then there's something clearly wrong with as long as you're obeying your stops, right? But then we got to figure out why you cannot read a chart correctly, quite frankly, because that's the object it could be. Nobody's that unlucky in 1,000 trade. It's just not reality, guys. And it doesn't matter if you day trade, swing trade, or invest, these rules apply. The beauty of what I've always taught, what Josh saying, the same thing. We've stopped looking in terms of how much am I making or losing? How many R's did I make? I lost an R. I made 7 R's. I mean, the Traction Group has seen a version of what he has just shown you that's called drop and drag, which is my creations going back from late 90s, early 2000s. That's an automatic version that basically does all that for you in the real time. You take the trade, you size everything up, you frame it, and then you take your hands off the wheel like a self-driving Tesla, and it has all that figured out for you in the real time. Every bit of it. And that's the beauty of it, because what I have found in my own research personally is 80% of traders struggle in trade management. That includes the money management, size, the port, all those little pieces in that little cube. That's what I find most traders struggle with. And that's what caused a lot of them to blow up and quit trading, because they don't understand this and they were never taught, or they don't know they need to pay attention to it. You can't tell how emphatic I am about this, guys. It's oxygen to a real trader, a real investor who's going to do this long term. It's one thing to read a chart and trade, guys. Another thing to have good money management practices. I give lots of stories behind this, but kudos to you, both of you. And Josh, I appreciate you sharing what you did, because I think it's lifeblood for most anybody long term. So I'll get off my tangent with it, but it's great.
Yeah, I want to end today a little differently. Chris, I don't know if you have any closing remarks you want to make. I think I'm going to I'm going to take the last word today. I have a little something I want to share with you guys. I think it'll be an encouragement here. So Chris, I'll let you wrap up, and then I'm going to take the last word.
Yeah, just kind of riffing on what you guys have been talking about, what we've been talking about today. Like the problem most people have is not making money. Like most people are able to read a chart, see trends, do their analysis and all of that. Where people screw up is they're not able to not lose money, right? Like, so if you can handle the not losing part, the winning just kind of takes care of itself, which is something that Josh likes to say a lot, especially as we go through foundations of trading. So I think that's just kind of the main thing that we need to focus on. Yes, you have to learn how to read a chart, and like, you know, you have to be able to put a trade together in the first place. So you have something to risk money on. But beyond that, it's pretty much just all risk management. You can be a very successful trader without doing anything very advanced. You can do very simple, you know, support and resistance, trend lines, all of that, and still have a successful career trading as long as you can manage your risk. So that is probably the most important thing, is just learning how to manage risk. So I think, Scott was mentioning this before, that, you know, most traders are trying to find the next best strategy, the next thing that's going to make them all of this money. But really, we should all just be focused on not losing money. And that would make our results far, far better. So that's the last word that I would have. Also, like and subscribe.
Yes, like and subscribe. Indeed. I was thinking through, and I'm going to cut some of these as videos. And so I'm going to you guys will be a trial run on this. I haven't shared this before, but I think that it's appropriate for the conversation that we're having right here. And there's a story that's told that one day a door-to-door salesman woke up and realized it was pouring rain outside. And he thought to himself, man, it's pouring rain outside. I don't think I can possibly go out and make sales today. There's another salesman that woke up the same day and he looked outside and he said, man, it's pouring rain today. I bet everybody's at home, including the other salesman. I can't afford to not go out and make sales today. The difference in perspective that you have can send your life in a completely different trajectory. And I've been seeing this go around a lot on social media. People are freaked the everlasting heck out. Inflation, economy, interest rates are going up. The stock market's pulled back. There's a lot of reasons to wake up and look outside and realize, my gosh, it's raining out there today. But the question is, what are you going to do about it? Are you going to be the salesman that says it's raining, there's nothing I can do about it, I'm going to just stay home? Or are you going to be the salesman that says, I can't afford to not go out and take advantage of this opportunity? My friends, there's opportunities in every market condition. And we started this last week, and it just kind of was on my mind, if you can't tell, since then. The internet is the great democratization of opportunity. With a little bit of education, a little bit of preparation, and a whole lot of discipline, and I can do this kind of attitude, there is opportunity for you in this current rainy season that we're in. TradeSmart focuses on teaching people how to put cash in their jeans, trading the stock market. That's an opportunity, and it is extraordinary. Scott said at the very beginning, I got him on recording, the very beginning of the year, what did he say? It's the year of the trader. It's not the year of the investor. We've seen that. It's the year of the trader. If you knew how to trade, you put some serious fat cash in your jeans this year. If you didn't know how to trade, if you weren't prepared, if you looked outside and said, oh my gosh, it's raining, I can't possibly go out and take advantage of this opportunity, then your account could be down 40%, like the person Scott was talking about earlier this year. There's other opportunities to make money in the stock market. Personally, I think you should be well-rounded and take advantage of all of them. I just had lunch with a gentleman yesterday, and he's a very gifted, inspirational speaker person. And we were talking about ways that he can monetize that online. There's an opportunity. You have a zone of genius, and there's an opportunity to leverage that, probably online, maybe offline. I don't know what it is. The way that I would consider looking at this is, How do I create multiple streams of cash flow? The stock market being one of them. That's one of the ways that we put cash in our genes as a family, which creates an extraordinary abundant life for us and allows us to provide an extraordinary abundant life for those around us. So I want to leave with this. I want you to ask yourself the question, what will you do when it rains? Because it's raining outside, friends. And you've got two choices. You can step up, embrace the rain, take advantage of the opportunity that's before you. Or you can stick your head in the sand and say, my gosh, it's raining outside. What on earth will I do? The decision's yours. I'd love to see you all in Foundations of Trading. Keep your eyes posted. We're going to be doing some cool 5-day challenges coming up soon here at TradeSmart University. Scott Landers is going to be kicking off a new apprenticeship in June. If you love the way that Scott trades, as his loyal fans and following do, there may be some spots that open up in there. I'll tell you, they're hard to come by. I've never in my life seen somebody that keeps such retention. These people keep coming back over and over and over again to study with Scott because he's just that good. He's amazing. But we'll let you all know about that. Blessings on each and every one of you. We'll see you back here, same time, same place next week. Spend a little time thinking, what are you going to do when it rains? Take care, y'all.